Good morning, all of you. Today we are going to discuss on lesson 6, and this is a very important lesson in the investment and portfolio management subject, and it covers the measures of performance. Now, as a portfolio manager, in order to compensate the portfolio manager, these performance measures are very important. So therefore, we need to have a good understanding about these performance measures and how the measures are being designed. So therefore, this lesson has a great importance. I will go to the lesson now. I think this particular thing will have certain type of performance measures, and there are different measures. It is your duty to see what measures are appropriate. All the measures are not really suitable for every type of activity, but you need to understand and you need to select the appropriate measure. So in order to do that selection, you should have a good idea or good understanding about the designation or designing of the performance measures. So that particular knowledge you can gather from this lesson. Right. So the lesson is captioned as portfolio performance evaluation, and we will discuss these topics under the lesson. The first thing is importance of portfolio performance evaluation. Then net asset value per share as an indicator of performance. That is the first theoretical performance measure. Net asset value per share as an indicator of performance. Then the next indicator is the 1 period rate of return. I think that we have already discussed in another subject area when we talked about risk return trade-off or whatever. But this is the same thing we discuss here. Then you have another one called geometric mean return. Geometric mean return, and we put it in simple form and shortened form, GMR. Then applications on Sharpe's performance measure. Now that measure is a particular performance measure with certain risk premiums and connection between the total risk and the premium. And Trenner's performance measure is also another type of measure which involves beta values. Then the comparison of performance measures. And the last one is very much important one, and it really applies a model where you can say at a certain probability what would be the future investment value of a certain investment. And I think in this lesson, this will be a valid type of model for performance measure of investment. So you will see when we discuss about those things, and you will find that different mathematical indications are there in the last one, that is future investment value as a measure of evaluation. So that one actually that is a model invented by chartered financial analyst Chartered Financial Analyst Association. So therefore, it's a valid one in terms of measurement of performance of investment. Right. Now, any investment company, in their business model, the objective is to optimize the risk-return trade-off. That is under any objective of investment company. Now, these measures, the performance measures, are also really based on the degree of optimization achieved. Now, how optimal their solutions. So that is the measure. Now, when you have a high level of a performance measure, that means now they have achieved a high degree of optimization. But we need to select the performance measures on the basis of quantitative and qualitative factors relevant to the entire entity's operational setup. I think that has a great discussion opportunity. So I need to get your ideas also now in the process. You can prepare with your own ideas, so we can have a discussion even at a particular level. So at the end of the lesson, even we can have a discussion on this, because these things are very important rather than calculations, because it will give you some qualitative understanding about these things. Now, that is very much important in your day-to-day activities, because if you don't have that sense, I don't think that you will get the real applicability of these things. Now, in case of a investment manager or the person who looks after a portfolio, these qualities should be there. If you don't have these qualities, you are doing a routine type of a thing which you cannot add value. If you want to add value into your business activity or your job activity, you need to have a real understanding and real sense. If you don't have a real understanding and real sense, you are just doing a routine work, which may not add value to your job or your business. Right. Now we will go to the net asset value per share as an indicator of performance. Now that is a very simple thing, and most of the time this is being used. Now, it is a very simple phenomenon where you can get the net assets. You all know that in a balance sheet structure, net assets given by assets minus liabilities. So then you get the net assets. Your liabilities are normally less than the assets, so therefore total assets. Then you get the net asset value. Normally this net asset value is mapped to the net worth most of the time. But when you say net asset value, it is a market related value. So you get the net asset value and it has to be divided by number of shares. So then you get the net asset value per share. Simple phenomenon, nothing serious about it. I think you all have seen these things in final accounts, and I have seen in many publications of accounts, they give this net asset value per share underneath. So then if you compare 2 years of 2 financial years, you are in a position to compare the last financial year's net asset value and this financial year's net asset value, and you check whether net asset value has increased over the year. So that's another lookout, and it is a simple one and everyone knows about it. So that is what you call the net asset value. But however simple it is, you have to have an idea about it. even though it is simple. And I have given a small example also here. The National Growth Fund has a total amount of assets equal to $60.1 million. Its liabilities are $100,000 and the number of shares are equal to 7 million. I know it's a simple thing. What you need to do is you need to get the assets value, and then it has to you have to deduct liabilities from that value. So that is 60.1 million minus 100,000. So that comes to 60 million. And number of shares 7 million. So therefore 60 million divided by 7. So 60 divided by 7 comes as 8.57. So that is the net asset value per share. And that is simple as that. Then we go to 1 period rate of return. Now, of course, now here, this 1 period rate of return comes together with net asset value. Because we compare the net asset value for a time period. Now, we have to have the net asset value at the start of the time period and at the end of the time period. We have a normal assumption that net asset value has increased over the period. With that assumption, we have this formula. NAVT is the net asset value at the end of the time. NAVT minus 1 is 1 year before that. That is the year, beginning of year situation. And the end of year situation minus beginning of year situation gives you the increase of net asset value, and it has to be divided by starting net asset value. And you can see there are other two factors coming here, CT and DT. CT is the capital gains, and DT is the dividend gains. RT is the funds returned for time period T. And these are simple, these also a simple formula. But you need to keep in your mind that you have to consider the capital gains as well the dividend gains or dividend disbursements during the period. If there's no dividend disbursement during the period, we are not going to have it, and it will become zero. But you might have a capital gain. It might be a capital gain or a capital loss sometimes, because if the value of a share comes down, so then invariably it's a loss of capital. So therefore, you can have even positive or negative values for these things, but you have to have the fundamental application here. Right. There's a small example here, a simple example. Now, company A has the following information. Now, I have taken 3 years, 2017, 18, and 19. Now, ending NAV or ending net asset value given, capital gains distribution given, and cash dividends given. Now, in 2019, ending net asset value $45, capital gains distribution $125, and cash dividend is only 25 cents. If you take the other company B, that also has ending value NAV as $50, capital gains as $3, and cash dividend as 45 cents. Now the question is, which company has the at the higher rate of return in year 2019? So in order to check that, we have to calculate return for 2019 for company A and company B. Now, in order to calculate the return, we can apply the formula. Now, in the formula, I told you earlier, capital gains and the dividend distributions has to be added. Then you have to add the net asset value change. Now you can just see in the company A, end of 2018, the net asset value was $40. And end of 2019, the net asset value was $45. So it really implies that in the year 2019, at the beginning of the 2019, 40 was the net asset value. So you can have 40 as the earlier net asset value. Ending net asset value is 45. So 45 minus 40 will give you the increase in net asset value. So you can just see how it is being calculated now. Here you get $5. 5 plus 125 is 625. 625 plus 0.25 is 650. 650 divided by 40, you will get 16.25% as the return for 2019. Now this is the return for 2019 for the company A. Using the equation for company B, you can apply the data given in company B with regard to the net asset value. You can see the net asset value, ending net asset value is 50 and beginning net asset value is 42 for the year 2019. Then the net asset value change would be 50 minus 42, and you have the dividend and capital gains as 3 and 45 cents. Then you get 3 and 45 cents plus 8. That is 345 plus 8, that is 1145. 1145 divided by 42, and which comes to 27.26%. Now you can compare the returns of two companies. The company A will have a return of 16.25 and company B has a return of 27.26. Now, comparing the two returns, we can see the company B had the higher return. That is the answer for the question, and very simple. But only thing is, now you need to understand and you need to memorize the formula, but this is not a big formula. So what you need to do is you need to see the change in NAV or net asset value, and you have to add the capital gains and the dividend gains, and it has to be divided by the beginning net asset value or initial net asset value. So that is the only thing here. There's nothing to by heart or whatever, if you know the situation, because you need to calculate the return. So the return has to be calculated in this manner. That is how the return is calculated. So I have seen in even in what you say, the stock markets also, in some cases they calculated the net asset value or return in this manner. Now you can see what really will happen when tax rate is really involved. I think invariably in most cases, in any country or in any jurisdiction, income tax is a must for this type of things. So then now income tax has to be in two forms. There will be a capital gains tax in some countries and income tax also. I have given in this example the income tax rate as 33% and capital gains tax rate as 30%. Now we have to calculate the after tax returns of the company B. Now what will be the particular thing? So we can really check. I think this is the most important part of this return, one period rate of return calculation. Now tax involvement also to be included here. So when you include the tax involvement here, you just check. This is the dividend capital gains. Now capital gains has to be multiplied with 1 minus T, because the tax deduction is capital gains for tax deduction is 30%. That is why I put 1 minus 0.3 here. And for dividends, it is not the capital gains applicable, it is applicable the income tax. So 1 minus 0.33. Now T refers to the income tax here, and T refers to capital gains tax here. So you can have the result here. So then when you calculate the return for 2019, these are the tax adjusted capital gains. These are the dividend adjusted, sorry, tax adjusted dividends. Now 210 is the tax adjusted capital gain. Since 30 is the tax adjusted dividend gain. Then there's another thing here. 50 minus 42 and net asset value difference. Now that difference also to be applicable the tax rate, because it is also capital gain. So therefore, they are also the capital gains tax has to be included. So they are also, we have to multiply that with 130, 1 minus 30.30. So then after the calculations, you will get this 240 plus 560 divided by 42. So that is 19.05. Now you can see this is for company B. Now you can see the company B's return without tax. That return without tax is 27.26, whereas if you apply the tax for that, the return has come down to 19.05. Now, this is a very important point to note, because the tax adjustment is an applicable thing in any country. So therefore, you need to have a good idea about these things according to the country's law, because then you need to understand the income tax, where the income tax is applicable and where the capital gains tax is applicable. Now, dividends dividends have a connection with income tax. Capital gains will have a connection with capital gains tax, or even other share value differences also include capital gains tax. I think that is a good thing to memorize, or that is a good thing to realize. Then we go to the, I don't know, do you have any questions on this? If you have any questions, I can just go into that. And yes. You have any question on this?
Sir?
Yeah.
So on that question, for the denominator, why don't we do that tax adjustment for that also? For the denominator, that 42?
No, that's a good question, but really this tax adjustment is necessary only for the gains. But that is not a gain measurement. Now, when you say 42, that is the first initial net asset value. No, now that is a benchmark only. So the tax has to be adjusted only for any type of an income or any type of a gain. There's no gain in that. No? That is why the tax is not been applicable there. Is that clear? Tax is applicable only for gains, either income or capital gain. But when you say for that particular initial value, there's no gain in that. No, it is only the value, the point. So therefore, tax is not applicable there, because it is only a benchmark. Because we need to calculate the gains in respect to the initial value. That is why we put the value in the denominator. But the tax application is not there. I think you got my point.
Yes, yes.
Because in other words, now the tax is only applicable for what? Either for income or capital gain. There's no income or capital gain in all them. Therefore, the tax is not applicable there. Now, I just tell you, I mean, when you say C is the capital gain. So that we apply the tax. Then we have dividend, that also we apply the capital gain tax. Then, sorry, income tax. Then we have a net asset value increase also. Since it is an increase, it's a cash flow. I mean, so that is also there are also tax applications there. But that earlier one, the earlier value, it is only a benchmark where we can get the percentage calculated in relation to that. That is why we put it into the denominator. So therefore, there's no tax application for that. Right. Okay. I think that is fair enough. The explanation. Any other question? And make sure that you need to understand the application of capital gains tax and application of income tax. Where to apply the income tax and where to apply the capital gains. So that is what you need to understand. Okay. Right. I will now go to the GMR, that is geometric mean return as a measure of return. Now, this is a very important one. Why I say important is generally people go for normal average, arithmetic average. Arithmetic mean we call it. But geometric mean is a certain theoretical and applicable thing in the investment management. And we call it multi-period rate of return. There's another name given. We can call it multi-period rate of return also. The geometric mean return for an investment can be calculated with the following equation. Now, it's a simple thing, but some calculations are involved. Now, you just check this formula. Even though the formula looks like some complicated, but it is not so complicated. This is the root. We call it teeth root. T is given here. 1 plus R1 into 1 plus R2 dots and 1 plus RT. And that's the multiplication of rates. Multiplication of rates. So when you say multiplication, you have to add 1 for each rate and multiply. And say you have now 3 rates here, then you have to get the third root. When you have 2 rates, you get the square root. When you have 5 rates, you have to get the 5th root. Then minus 1. That will give you the GMR. And this is a simple thing. And if you have a calculator with you, then it is not so difficult. Where GMR is the geometric mean return. R1 is the return for the time period 1. R2 is the return for the time period 2. RT is the return for time period T. And T is the total number of time periods. Now, if I apply 3 years. First year, the return is R1. Second year, the return is R2. Third year, the return is R3. Then how this GMR is calculated? Then we have to say 1 plus R1 into 1 plus R2 into 1 plus R3. Third root minus 1. That is the GMR value. Now we can go for an example. The Jupiter Corporation has had the following returns for the past 4 years. Now here on the face of it, you can see the T is equal to 4 here. Determine the Jupiter's geometric and arithmetic mean rates of return. Which return is higher? Which return is larger? Now you can see for the consecutive years, they have these returns. In 2016, they have a return of 14%. 2017, minus 5%. Now, when I say minus, what is the meaning? It's a loss. 2018, 7%. 2019, 9%. Now, these are the returns gained by the company for the last 4 years. This is the solution. Now, what I did? I start with 14%, that is 0.14. 1 plus 0.14 is 1.14 into, here you get 1 minus 0.05, 1 minus, again into 1 plus 0.07, 1.07, 1 plus 0.09. Now here you get 1 minus 0.05 is, it would come to 0.95. So then the multiplication is 1.14 into 0.95 into 1.07 into 1.09. That comes to 1.2631. If you want, you can just do the calculation and see whether this is correct. And it is fourth root you are going to take. And the fourth root will come as 1.0601 minus 1. Now you might get an issue here. How are you going to get fourth root from a calculator? Now, if you use the calculator in the form of FX90, FX100 or something like that, Canon or whatever, what you need to do is we have to just put 1.2631 and then there's a arrow mark and then have a brackets, and within the brackets you have to say 1 over 4 or 1 divided by 4 within brackets. Then you will get the value. Because when you say fourth root, it is the 1/4 power. That is how it is being calculated. If you have a Texas Instruments calculator, then you have a key, YX key, then you put 1.2631 and press YX and then press 1/4. Then press 4 and 1 over X. Then you will get the value. If you have that type of a calculator. But I think most of you have these Canon and Casio type of calculators, so then you can have this way then. I don't think that it will be an issue. And what is arithmetic mean? And so it's a very simple one. 14 minus 5 plus 7 plus 9. And it comes to 25 and it is 6.25. Now when you compare the two things, you can see this geometric return, mean return is a lower value than the arithmetic mean. I think most of the time it is the case. The arithmetic mean return will always exceed the geometric mean return. Right. I don't think that it will be an issue for you, this geometric mean return calculation. Then we go to the next performance measure. Sharp-A's performance measure. Now, as it is, it's a ratio of a risk premium to the total risk. Now, the risk premium as a percentage of total risk, as a ratio of total risk. So if the value is higher, it is better. Higher the value, better. So what is the fundamental reason for that? What do you mean by risk premium? Risk premium is the return over and above the risk-free return. That is what you mean by risk premium. Because when you deal with the risk-free asset, invariably you will get the risk-free return. But when you deal with the risky asset, you expect a higher return than the risk-free return. So that is the higher, that additional part is called the risk premium. And that risk premium as a percentage or as a ratio of total risk is taken at the Sharp-A's performance measure. I think that gives a certain rationality. And we consider, if you compare two investment companies, and if we calculate the Sharp-A's measure for the both companies, the higher measure is with the better performing company. better performing company. Now just check the symbols. SP, S and a small p, and we call it suffix P. SP, sharp space index of portfolio performance for portfolio P. RP is the average return for portfolio P. Sigma P is standard deviation of returns for portfolio P. R is the riskless rate of interest or risk-free interest, we call it. And this is as simple as that. Risk premium. Now, from here onwards, when we refer risk premium, that is nothing other than the return minus the riskless return or risk-free return. That is what you call the risk premium. Total risk is the sigma or standard deviation of returns of portfolio P. If you go to a portfolio. Right, now we go to the example. The rate of return and risk for 3 investment companies were calculated over the most recent 5 years and are listed below. Now these are the averages. For investment company A, return is 15%. Standard deviation of return is 16. Rank each company by Sharpe's index of portfolio performance if the risk-free rate is 7%. Now this is also the average risk-free rate. Now you can just apply the formula. Here the portfolio return is 15. Risk-free return is 7. 15 minus 7 is the premium. When you divide it by standard deviation, you get Sharpe's index for portfolio or investment company A. For investment company B, it is 13, that is return is 13 and risk-free rate is 7, and it is to be divided by 18, the standard deviation. And for company C, 12 minus 7 divided by 11. And the values will come as for investment company A, the Sharpe's index is 0.5. For investment company B, Sharpe's index is 0.333. For investment company C, the Sharpe's index is 0.455. And as per the ranking, now I have done the ranking in an descending order. The first one is the highest one. That is, now here the highest value is 0.5. So then SA, that ranks first. A ranks first. What is the second then? Second is 0.455 with C. Third will be B. This is the ranking. So if you have a preference or if you want to select one company from out of these 3 companies, you should go for A. You should go for A. And you need to have a second choice for C. That is how it happens. Then we go to another performance measure called trainer's performance measure. Right. I think there's nothing confusing here. It's a very straightforward type of a thing. Very straightforward. I don't think that you have a confusing type of a question or whatever. Yes. Then we will go to the next performance measure that we call trainer's performance measure. Trainer. Now make sure that you are familiar. You will be familiar with the names. Sharpe performance measure. In some books I have seen it. It is mentioned as Sharpe's index. Trainer's index. That's another way. But even in some books I have seen trainer's performance measure and Sharpe's performance measure. And make sure that put in the apostrophe and S, trainers and Sharpe's. We have given the real honor to those people. A person called Sharpe and another person called Trainer. This index is yet another index of portfolio performance. Here, there's a small difference. But earlier one, what we did was we just measured the ratio with total risk. Here we get the ratio against beta. Now, beta really signifies the systematic risk. So therefore, in earlier one, in Sharpe's index, the signification comes with the total risk. In Trainer's measure, the signification comes with the beta or systematic risk. That is the only difference here. So the Trainer index is also risk premium divided by beta. Now here, in place of total risk, the beta comes. All others remain same. Now here also, there's an example. Now in this example, you have these calculations, and for company A, the Trainer measure is 6.96. For company B, the Trainer measure is 4.8. For company C, the Trainer measure is 5.55. The ranking would be, what is the highest value here? A. Will get the highest value. Then what is the second value? The C will get the second value, and B will get the lowest value. Now you can compare these ranking with earlier rankings with regard to the Sharpe's index. I mean, you can see both rankings are same. Here also we got A, C, and B. Under Trainer's measure also we have that ranking, A, C, and B. Now, this comparison of performance measures would be very much important here. The Sharpe performance measure is based on the capital market line and total risk, which makes it more suitable for evaluating portfolios rather than individual assets. So now you can get a certain idea with regard to the applicability of this Sharpe performance measure for the portfolios. But that doesn't mean it is not applicable for individual assets, but I think it is better applicable for portfolios. On the other hand, the Trainer performance measure is based on the capital asset pricing model and are more flexible because by using systematic risk, it can be used to evaluate the performance of both portfolios and individual assets. Now you can see in this comment, what they said was the Trainer measure would be more generalized than Sharpe measure. But you make sure that your portfolios are diversified. Right. Now I will just direct you to a question at the end of the lesson. The question number 2. Use the following information and answer the questions. I think you all can get involved yourself with this problem and do the calculations and do these rankings now. Oh, I think you just apply these two things only, A and B, part A and part B. Just do the ranking of the portfolios according to the Sharpe measure first. Simple, very simple one. Because I want to just put you into an involvement. That is why I just ask you to do this. Otherwise, I can just proceed further. But what I feel is you also should engage in something here. Otherwise, this will become a very boring thing. And you need to, at least you need to ask questions, engage with something. Then only you will gain something from this. Otherwise, this is a very trivial type of exercise. Because all data is available here with regard to your calculations, all the data available and very straightforward also. No any confusing type of things. Yes, anything you need to clarify or whatever? Yes. ACA. I have seen one answer. Others also can try. And these are very simple thing. Good, good. Yeah. Very good. Right. I think if a person, now if you have done the part A, then you can try part B also. And fortunately, you can expect this type of sum in the question paper also, though it is easy. Because I normally give 1 or 2 questions to score for anyone. But of course, you may not get a very straightforward one from this type of a subject area. There can be some other involvements also. Right, good. I can give the, anyway, so try the other one also, B, Reynolds measure. Right. Now, according to trainer's performance measure, betas are available here. But then you can do for that. That is also very simple. And you need to check whether the same ranking is possible with the trainer's measure also. Now, Sharpe performance measure, you had the ranking. Just check whether under the trainer's performance measure also the same rankings come. Now, at part C is do a comparison of your rankings and give an appropriate justification. But anyway, we are not going to try that part, but up to part B you can try. Yes, I think for that also, under trainer's measure also, you get the same rankings. Good, good. I mean, you have done it well. Right. I think others also can check whether they have got the correct answer. The ranking will be B, C, and A. But when you rank it, you have to say whether it is descending order or ascending order. Or you can say rank in first, second, and third. That way also you can give. Right. Now we will go to another subject area, and the most important subject area in this lesson, and a mathematically sound part of it. Future investment value as a measure of evaluation. Now, the background I will tell you. Now, in an investment company, if you do some investment on a portfolio and you want to achieve some level of return. So, for example, now you think that with the historical data and historical trends and all, you will see your investment will be tripled, become 3 times higher after 10 years or so. And under this measurement, what you can do is you can see what is the probability of achieving 3 times of your investment, or as a gain of 3 times of your investment. 3 times gain, 3 times of the investment gain after 10 years. So the concept is this. So that is where we have to check the probability of having such a gain. But there are several assumptions in this. Now, you have to be careful to see whether the assumptions are possible. Now, these are the assumptions. The returns of the investment are log normally distributed, and the logarithms of continuous returns of the investment are normally distributed. Now, when you say returns of investment, now it can have a distribution. I mean, in some period of time, there can be a particular type of return, another period of time, another return of another type of a return. And this distribution is log normally distributed. Now, I think you might wonder what do you mean by log normally? I don't know. You have an idea of normally distributed? What do you mean by normally distributed? What is the meaning of normal distribution? Now, when you have a distribution graph, or distribution can have a graph, that graph comes in a bell shape. Such distributions are called normal distributions. Now, and those distributions are called, the distribution is normally distributed. Now the thing comes as what do you mean by log normally distributed? Now, if a particular variable is normally distributed, and if you take the logarithm of those variables, and logarithms of those variables are also normally distributed, and we call it log normally distributed. Now, say for example, now you have a certain type of variable. That variable is not normally distributed. But if you take the logarithms of the variables, and that will be distributed in a normal distribution. So such variables are called log normally distributed. Now just check what are we going to refer as the variable here. The returns of the investment are log normally distributed. So investment return is the variable we have taken here. Investment return is the variable we have taken here. And that variable is log normally distributed. And logarithms of continuous returns of the investment are normally distributed. I think it really refers to the same thing. It refers to the same thing. And the other very important assumption is the future will be similar to the past. The future will be similar to the past. Now, that is the very important assumption here. Or in other words, if you have observed a certain trend in the past, that will continue. So that is the assumption, the other assumption. So normally what we do is we just go through the returns. and we call it continuous returns. Continuous returns for a very long period of time. And we assume that the same trend prevails in the future. Now, if you find any investment compatible with the above assumptions, we can apply the future investment value model. Now, actually, this model is invented by the research foundation of the Institute of Chartered Financial Analysts. Now, I want to give some information about this Institute of Chartered Financial Analysts. I think most of you have heard about this CFA examination, and there are some CFA holders in Sri Lanka. And the institution who conduct that examination is called the Institute of Chartered Financial Analysts. They are the people who invented this model, and their research foundation was really a reputed research foundation, and they just invented this model. Because they have applied statistical and mathematical equations and analytical things here, they have come up with this model. Now I will go to the model. Now, I mean, apparently it looks like a cumbersome type of formula, but it is not so, because you don't worry about by heart in this formula. You will get the formula in the question paper. Don't worry about by heart this thing. But you have to have a good understanding about the model. That is being checked at the examination, not the memory about the model. It will be given in the question paper. Now I will explain one by one. Now we said the model is really giving the value for Z. Z is equal to Ln, that is logarithm for natural. We call it natural logarithm, Ln. Ln of FV divided by B. What do you mean by FV? That is the future value of the investment. B is the beginning value, beginning investment value. Now, for example, say if you begin your investment with 1,000 rupees and you expect in 10 years you will get 3,000 rupees. So then FV will be 3,000, B will be 1,000. Then you have to get the logarithm of 3,000 divided by 1,000, that is logarithm of 3. Logarithm of 3. Right, okay. Then you have another symbol here, RC. Average continuous return of the investment. Now, when you have this average continuous return, you have to have a long period of time to come into such averages. And of course, you assume that the same return, continuous return, will prevail in future also. Then another factor is sigma s, the standard deviation of continuous returns. Then n, number of years, the meaning here is the projected number of years, or in other words, the future years. So if you apply the formula today and you are referring to a future investment value, so therefore that period of time is referred to as number of years. So if you are looking for a future investment, say another 10 years time, so n will be 10. Another 20 years time, that n will be 20. Likewise, you have to have different numbers. Ln is the natural logarithm. Right. Now you get yourself familiar with the model. And I want to say that this is also a very possible type of question in your question paper. And in the question paper, it is not only the calculations are evaluated, the assumptions and other types of explanations are also evaluated. So just having the answer will not do. So therefore, you need to have quite a good understanding about this model in order to apply and in order to answer the question. Because you have to write necessary things or necessary assumptions in the question paper. Right, shall we go to the example now? Ms. Swarnapali has $100,000 that she plans to invest for 10 years in a fund, which is equally weighted with S&P 500 index. Now, I think this particular application you need to understand. Now, what do you mean by S&P 500 index? Now, there are 500 companies coming under the Standard and Poor index, and that is what you call S&P 500 index, and it's just like a stock index in Sri Lanka, ASPI, all share price index, and in Sri Lanka also you have S&P 20. It's a Sri Lankan index, but this S&P 500 is a global index, and it involves 500 companies' share prices. So that is what you call S&P 500 index. Now, equally weighted means we can refer to the S&P 500 index and apply the continuous return and continuous standard deviation on the S&P 500 index for the calculations here. That is the real applicability of that. That is why we put in the question 10 years in a fund which is equally weighted with S&P 500 index, and it really has the same characteristics. And here in the question it says the standard deviation, the continuous return and the continuous standard deviation on the S&P 500 index has been 11% and 18% respectively over the past 70 years. You can see when you say 70 years, it's a lifetime. It's a lifetime. Using these return and risk values for the future, determine the probability that Swarnapali's investment will double over the next 10 years. So this is a particular problem or example where you can apply the model of future investment value, and we have to see what are the types of symbols used for these numbers. Now I think you all can just apply the model. Z is equal to log. What is FV here? Future value. Swarnapali has 100,000 that she plans to invest for 10 years in a fund which is equally weighted with S&P 500 index. The continuous return and continuous standard deviation on the S&P 500 index has been 11% and 18% respectively over the past 70 years. Using these return and risk values for the future, determine the probability that Swarnapali's investment will double. So, in such a situation, what is FV? It will be 200,000, because then your measurement will be based on that. So it should be 200,000 and B would be 100,000, and FV divided by B would be 2. Then in the first place, you have log 2 minus, what is RC? Continuous return. That has been 11%, and they assume that in the future also it will be the same. So then it is 11%, and we can put it as 0.11. Then into N. Into N. So what is N? Is it 70 or 10? We are referring to the number of years in the future now. We are waiting for that years. So it's not 70,000 we are referring to, on 10. Divided by sigma S. Sigma S is the standard deviation of continuous returns. As per the example, it is 18%. So then you have to put 0.18 here and square root of 10. I will show you the calculations. Now, when you write these things, since for the last 70 years, continuous return and standard deviation has been 11% and 18% respectively, it can be assumed that it would be same in the future. And the other assumption of normal distribution of logarithm of returns also considered. We can apply the following future value model to determine the relevant probability. I think this type of writings are very, very important when you work it out in the question paper. Otherwise, you lose marks if these things are not available in the question paper. Right. Beginning value is 100,000. Future value will be 200,000, since it says it will be doubled, or they are going to find out the probability of doubling it. And RC is the return, continuous return for the last years, and we assume that in the future also it will be the same. 0.11, N equals 10, sigma is equal 0.18. Now we apply the values here. Then you get log 200,000 divided by 100,000, that will become 2, log 2 minus 0.11 to 0.11 to 10. So when you work it out, you will get minus 0.406853. Divide by 0.18 into square root of 10. That comes to 0.569210. And when you do the division of here, the calculation, you might get minus 0.714768. Now, Z value we found by using the equation and substituting the values into the equation, you found the value of Z. And since the availability of these values in the table, because when you have a Z value, the meaning is we have to look for a table to see the applicable area under the curve to the left of the Z value. So that is the necessity we have now, and we need to get the help of normal curve table to do the calculations. Normal curve tables. Because what we need to do is we need to see the we can get the area to the left of the Z value in the normal curve, but our probability is given by the other side or other value. Anyway, this is I will try to illustrate this on the board. But up to here, up to this point, I don't know whether you got it up to this point. Yes. What do you say? Now, up to the substitution of values to the model, are you okay? Yes. Are you okay with the substitution of values to the formula? Right. Anyway, now since we have found the Z value, yeah, of course, log 2. Log 2 can be obtained through a calculator. Right, now I have a calculator here. Now this is a Texas Instruments calculator, but you might have some other type. Even now in this calculator you have a button called LN, right? So you have to press 2 and press LN, and you get a value, right? That is how you get the value of L log 2, LN2. So LN2 value you can get that way, right? So make you now you can use your own calculator, the FX 100 or whatever. There are also the particular button is there, LN. The button is called LN. Right. Anyway, what I will do is I will just apply the values to the formula and show you the calculations. But there are the calculations, of course, I have done the final calculations there. Wait, then I will do that on the board. Now, just look at the formula. Log FV divided by B will come as log 2 minus 0.11 into 10. Now, just look at the board. Just look at the board. Now you can see the formula here, log FV divided by V minus RCN divided by sigma S square root of N. Now I just put the values. Future value would be 200,000. Beginning value would be 100,000. And here you get minus RC is 0.11 and N is 10. And divided by sigma S is 0.18. 18% is taken as 0.18. Right? And square root of 10. Now, when I go to the further calculations, here it comes as log 2. 200,000 divided by 100,000 is 2. Minus 0.11 into 10. That is 1.1. 1.1. And divided by 0.18 into square root of 10 is 3.1622. When you get the square root of 10 from the calculator, you will get this value. And now, as it is, I have taken it into only the fourth decimal here. Then you get 0.6931 as the log 2. So log 2 can be taken from the calculator. Log 2 value, all of you should get this value as log 2, 0.6931 minus 1.1. It comes to minus 0.4069. Now in my lesson, I have given some more decimals here, but here I just got only 4 decimals. To the nearest 4 decimals I put it here. So now when you work it out, when you just now you can divide 0.4069 by 0.569210. Then you need to get the answer. What is that answer? Yes, you will get minus 0.71485. But if you get the nearest 2 decimals answer, you will get Z as minus 0.71 to the nearest 2 decimals. To the nearest 2 decimals. To the nearest 2 decimals. To the nearest 2 decimals, you get the answer minus 0.71. Now, are you okay with that?
Sir, can you show the method, sir, how to get log 2 in fx 100 ms?
Fun. fx 100.
Yeah, fx 100 ms calculator, how to get log 2?
Yeah. Now, can you see the button for ln?
No, sir, only log button is available.
Right, but there, I think there's another second function.
Okay,
you
sir.
have to press another one and then get it. And I think the ln would be there.
Okay, sir. Okay, thank you.
Right. So then what you can do is you just put the value 2 and press ln. And you will get the value for log 2, ln2. Was it okay now?
Yes, sir. Okay.
Right. Now, after getting it, now you can apply the things here. And with all these divisions, you will ultimately get minus 0.71485. But in the tables, you have only 2 decimals, so therefore we can get the nearest 2 decimals answer here. Minus 0.71. I think the applicability now, what we need to do is, now this is like this. I will show you the curve. Now when I say Z is equal to minus 0.71, Z would be somewhere here. Minus 0.71. Now this axis represents Z. This axis represents Z. So it is 0 here, and to the left of 0 you get minus values, and minus 0.71 is here. So then you can have a mark here, and what we need to do is we need to get this area. We have to find out the area under the normal curve, and that can be done through the normal curve table. Normal curve table. I will show you the normal curve table now. Right. Now you get the normal curve table here. Now just look at the table. Now you can read the heading of that. Value of nx for given values of x for a cumulative normal distribution with zero mean and unit variance. Now when you say zero mean and unit variance means the z value we are talking about. Now just look at this normal curve table. Now since our z value is minus 0.71, you have to go for that value. Now you can just see minus 0.7 here. And when it is 1, 7.1 is under here. So therefore the required value would be this one. This one would be the required value, 0.7611. Sorry, this one. Minus 0.71 means it should come 0.2389. 0.2389. Now the meaning of this is we have found now the area under the normal curve, the percentage of the area. So now when you say 0.2389, the percentage would be 23.89. 23.89. Is that okay? This has already been downloaded to the computer, and I think you all can get access to this table. Then you have to go for the minus 0.71. You get minus 0.7 here, and 1 would be here. Then this is the value. This is the value. 0.2389 will be the value. Okay. Now I will show you what this 2389 is. So you will see here is the value 0.71 minus 0.71. From the table we got this value. It is the portion of the area to the left of this line, 23.99. So then we are in a position to get the area under this. What is the portion of area to the right to the minus 0.7 line? So that can be taken by deducting 23.89 from 100. 100 minus 23.89. Or we can get, either we can do this way. There are two ways of doing it. Now 23.89, rather than getting it as 23.89, you can take it as 24. You can take it as 24. So we can have an approximate value. So we can say 24. Then in the lesson I have put it that way. So therefore, what is the 100 minus 24 is 76. So the probability of doubling the investment will be 76%. Probability of doubling the investment will be 76%. That is the answer. Now this 23.89, now if you do that, you can just put it this way, 100 minus 23.89 will be it will be 77.11. Okay, you can say either what I did was I just put on the in the lesson that it is 76 point something or 76 rather. But actually, if you do the calculations for the with the decimals, you will get 77.18. That doesn't matter because you can really mention it what you have done. Are you okay with the calculation? Now this is a very very famous model with regard to the future value calculations. Right. Then as it is, you will find that now I will go to the lesson. Now here you get the values and you have to be careful to select the value with the correct sign, correct plus or minus sign. Now our value has, we have found that ZD is equal to minus 0.71. So then you have to refer this place. That is how we got 23.89. And in the first place, what you can do is you can say, you assume that though it is 23.89, you can say it is very close to 24. So then it's your probability would be 100 minus 24, that is 76. So then the answer would be 76. In my lesson, I have put it in that way. Right. Now, again, we have come to the example. Swarnapali's investment is doubled in 10 years with a probability of 76%. Now, when you say a probability of 76%, it's a rather substantially close probability where you can say there's a chance of 76% of doubling that Swarnapali's investment in 10 years. So, not doubling is only 24. Therefore, there's a high possibility of doubling Swarnamali's investment in 10 years. That is the idea you can get through the calculation. And I think this calculation is a rather mathematically sound calculation, and they have even this chartered financial analyst, and they really did a valid in research on this. Therefore, you can follow this. Anyway, we'll go for a problem. Right, number 3. I will read it for you. Ms. Ruwan Mali has rupees 1 million that she plans to invest in S&P 500 index fund for 30 years. That's a rather longer span. The continuous return and the continuous standard deviation on the S&P 500 index has been 11 and 18 respectively over the past 70 years. Using this information, find out the probability of Ms. Ruwanmali getting rupees 10 million after 30 years from the investment. Assuming all other factors remain same, determine the probability of Ms. Ruwanmali losing from this investment within 10 years. I think the things are rather straightforward. Now I will ask you to try this example using the, now when the sum, when you read the sum, you will find that you can use the future investment value model for this, because all the things are given with a certain compatibility, where they say continuous return and continuous standard deviation on the S&P 500 has been 11 and 18 respectively over the past 70 years. That means there have been a very established trend. 70 years means a rather established trend, and you assume that it will be same in the next 30 years also. So those assumptions are there. And this log normal and Lohmann assumption is also there. So now you can make use of the formula to get the probability calculated. Now the first part of it would be getting 10 million. That means the 10 times you get after 30 years from the investment. Right. Now you all can try this. While I am asking you to do that, I will give you a break and I will start the things by 10:30. Now, during the break, you can see how you can apply these things into the model and how you arrive at the probability of having 10 million in 30 years by Ruwanmali. Right. Then I will just break for the 15 minutes. We can just continue with our discussion. We will see. I mean, for the benefit of, I think a person has got some answer, 97 point something. Yeah. Z value is 2.11. Anyway, we will see. If you had any problem in calculating that, let me know. Then I can explain. Even now you got the answer. Is it as minus or plus? Now, in this particular example, the future years would be 30 years and n will be 30. But continuous return and continuous standard deviation remains the same. And we expect the investment to be 10 times. So then it will be log 10. All others remain same. Right. We will do the calculation and see what it is. Now, here it will be 100,000, 10 million. Oh, yeah. 1 million and 10 million. So, therefore, here it will be 30. Then what we need to find is log 10. Two 2.302 2.3026 minus 0.11 into 30 3.3 divided by 0.18 square root of 30 5.477. Now I will get the denominator and numerator values. Minus 0.9974 divided by 0.18 into 5.477 0.98586. You get the answer 1.01012 minus 1.012. So therefore, you can say Z is equal to, if I get to the nearest second decimal, Z is equal to minus 1.01 to the nearest two decimals. Now, since you have the value as Z is equal to minus 1.01, you have to go to the normal curve table. Now, under the normal curve table, now we need to go for minus 1.01. 1.01 minus 1.01. So it would be 0.1562. Because we need to go for minus 1.01, 0.1562. 0.1562 means yeah. So then this will be 84.38. It seems Ajipan's answer is correct. Ajipan's answer is correct. Anyway, now don't worry. Now, if you get a different answer, don't worry. So you can just go through it again and see what really happened. Now I have put it on the board. I have put it on the board because as per the sum, Ruan Mali's investment will become now he started with 1 million and it should become 10 million after 30 years. Now that is what we are going to check. Since it is 10 million after 30 years, now we have to try to see the probability of having it. So then you get to calculate log 10, then minus 11 into 0.11 into 30 and divided by 18 into square root of 30. There you get log 10 is 2.3026. is log 10 minus 0.11 into 30 is 3.3. Now it really comes to in the numerator 2.3026 minus 3.3, that comes to minus 0.9974. And in the denominator you have 0.18 into square root of 30. When you get the square root of 30 calculated, it will become 5.477. And denominator comes as 0.98586. And when you work it out, you get the answer as minus 1.012. As Ajipan mentioned, it is minus 1.0117. So to the decimals, 3 decimals, it is 2, and if I get it to the nearest 2 decimals, it is 1.01, minus 1.01. So with that, we did the calculation through the normal curve tables. Under the normal curve tables, we found it as 15.1562, that is 15.62. So when it been deducted from 100, it will become 84.38. So that is the probability of Ruan Mali's investment become 10 million after 30 years. So that is the answer for that. Okay, I think some of you have some connection among yourselves, so that's a good thing. So then you can discuss matters out among yourselves. So that's a very good way of learning. No? So I really appreciate that. Good way of learning. Now we can go for the part 2 also. Yeah, we can go for the part 2. Yes. Now, as it is, we just answered the first part of this question number 3. The second part will be assuming all other factors remain same. Determine the probability of Ms. Ruwanmali losing from this investment within 10 years. Now, how can you put a condition to depict the losing from the investment? So that is what we need to understand, how we can put it in the model. Now, if you do not get anything out of the investment, so if the investment remains the same, and if the investment, that means now you have not gained anything. So that is the limitation part. But if you again, if your investment becomes less than 1 million in 10 years, that is the losing point. So therefore, we assume the limitation of losing would become when the investment after 10 years also, there's no change with the investment value. It is the same after 10 years. So that is the point at which we can say Ruwanmali is losing from the investment. So then if we apply that, what will happen? Then log 1 million divided by 1 million. That will come as log 1. What do you mean by log 1? You can just check what is log 1. Here, what is log 1? Log 1 is equal to 0. Log 1 is equal to 0, and now here they talk about 10 years period, and then n will become 10. Others remain the same. Now we can check the probability of losing from the investment in 10 years. So we can check that. Anyway, has anyone tried that? Now, what we can do is, as per the second part, the condition is losing from the investment. Now, we can depict it on the model by assuming even after 10 years, there's no change in the investment, it remains same. So that is the point of losing. Now, losing means now if you have a lower value, that could be the losing thing, but losing starts with having the investment after 10 years even the same value. So that is the point at which the losing starts. So then if we depict these things in the calculations, you will find it. So I can just put the things on the calculations. Here it will become 1 million divided by 1 million Here it will become 10. Now we will do the calculations accordingly. Now what is log 1? Log 1 is 0. And minus 0.11 into 10 is 1.1. So then the numerator comes as 0.11 minus 1.1. And here you get the square root of 10, that is 3.162. 3.162. Right. Then you get the numerator as 1.1 divided by 0.18 into 3.1622. 3.1622. That is 0.5692. 0.569. So when you work it out, you will get 1.1 divided by 0.5692. 1.93. Minus 1.93 to the nearest 2 decimals. Now when you say 1.93, we will find it through the normal curve tables. I think some of the people have got it, 1.93. And as per the 1.93 value, we can just get the probability from the now we are trying to get the losing probability, so therefore we will see how it can be done. Shall we go to the right, 1.93 minus 1.93. Now, here it is 0, here it is 1. Minus 1.93 comes here. 0.0268. 0.0268. Now I will show it in this manner. Now you have to be careful here, because here the question is asked the probability of losing, not having a profit. So therefore, we don't need to deduct it from 100. The answer comes as it is. Therefore, the answer would be 2.68%. Losing in 10 years, the answer would be 2.68. Right? I think you all should understand what it is, because when we demarcate the normal curve in this manner, to the left of the line, now this is the line, to the left of that line, you find the losses. Losing probability is given there. Now, you remember that when we did it for the earlier parts, you found this particular area, that is the area where the losing can happen. So then the other area would be the area where the profits can happen. So therefore here the question is asked the probability of losing. So therefore we can get the same thing here. No need of deduct it from 100. If you do it, then it is wrong, because we then give the probability of having a profit, not the losing. I think that is understood. Any question on that? Then you have to be careful when the sum is given. You have to read it carefully and see what has been asked for. So then you can have a clear idea, and you don't need to be confused. Is that clear? Any question on this? Now I want to tell you that this is a very possible question in the question paper. I think if you go through the past question papers, you will find that every question paper contained this type of a question. Very straightforward, to apply only the things you learn. So, and it's a very easy one for everyone. Okay. Now I will go to another question here. Now I think you need to understand that when a question is given, it might not contain only one subject area. It can come with several subject areas together. I think this is the normal way of setting questions, because the subject areas are divided in order to give you a clear idea, and for the simplicity and for the ease of teaching things. But when a real life issue comes, all these subject areas are interconnected in the real life situations. So then you need to see how you can apply the things in real life situations. That is your skill. I think in the question paper also, I will try to measure or evaluate your skill on that, not the memory or whatever. If you can have a very stereotype things, and you can by heart things and do something, so that is not the skill I expect from you. The skill should be you learn something, you learn several principles, and all these principles can come in your real life situations. In a real life situation, how you can use it together. Not only one principal, there can be several principals interacting. That is what you need to understand. Right. Now I will go to the supplementary questions. Right. Now we will go to the question number 4. Consider the information given below. Now just look at it. Though you get it as the earlier one which we did, but it has a little difference. Now you get information with regard to 5 years from 2015 to 2019. Part A, determine the Sharpe's performance index for Lotus Fund for the 5-year period ending year 2019. Now what are we going to do about it? How are we going to do it for the ending year 2019? So you can suggest something. Now when you have 5 readings, how are we going to reduce it to 1 reading? So you can
we should calculate arithmetic mean.
Pardon?
We should calculate arithmetic mean.
Yeah, you can. What you can do is, now in Lotus Fund returns you have several returns and you can have the mean value for that. Now here the mean value we obtain through the arithmetic mean, not the DMR, not the geometric mean return. So this is only the arithmetic mean. So then what happens? You can get the values and added up, divided by 5. So in that case, Lotus Fund returns, the average Lotus Fund returns would be how much? You can calculate it and get the value. And for the earlier fund also, you can have the mean return or arithmetic mean of the earlier fund returns. And S&P 500 returns also, you can get the arithmetic mean. T-bill returns also, you can get the arithmetic mean. So now then what happens is you can do the calculations afterwards. Sharpe performance index to be calculated by getting the risk premium divided by total risk. So total risk also you can't see the yes, you can't get the, even though you get the mean value, the standard deviation is not given, but you have to find out the standard deviation. I think you have the data to find out standard deviation of Lotus and Aralia. So then, first of all, you need to find out the Lotus funds returns, standard deviation of returns, and Aralia funds standard deviation of returns. So by that, yeah. Anything? And with the calculation of standard deviation, you will be in a position to calculate the Sharpe performance index. And Aralia also. But for Aralia, what are we going to do about it? Aralia also the same, because for Aralia fund also you can calculate the mean value, and through the mean value you are in a position to calculate the standard deviation of returns for Aralia fund also. But when you go into the trainer's performance measure, what is missing here? The beta is not given. Beta is not given. So therefore, what we can do is, by applying the capital asset pricing model, you are in a position to calculate beta. Beta can be calculated by using the capital asset pricing model, because here you have the returns, you have the market returns, you have the T-bill, say T-bill returns also. Okay, the average of T-bill returns will give you the risk-free rate. So you will be in a position to calculate beta by using the values here. And after calculating the beta value, you will be in a position to get the trainer's measure calculated for Lotus and Aralia. Because for Lotus you can calculate the beta, for Aralia also you can calculate the beta. Is that clear? But this really, this is not as easy as it appears, because it involves some of the calculations where it is not given. The data is not given here for some things. So, but we need to find out those things through the data available. Right. So then, first of all, you find the arithmetic mean of Lotus fund returns, arithmetic mean of Aralia fund returns. Yes, do it now. Now you should get Lotus fund returns as how much? Yes, 13.2. Earlier 8.2. Correct. Now, what else you need to do now? You have to get the Aralia and Lotus funds standard deviation. So in order to do that, you need to deduct this value from each of the values and get the square of it and divide it by 5. So that also you can do now. Now, when the standard deviation is calculated, what we need to do is get the arithmetic mean deducted from each and every value and all these values to be squared. So you get 5 squared values and added up, divided by 5 and get the square root. Then you get the standard deviation. Now when the standard deviation is calculated, what we need to do is you get the arithmetic mean deducted from each and every value and all these values to be squared. So you get 5 squared values and added up, divided by 5 and get the square root. Then you get the standard deviation. Now I will just go into Lotus fund returns, and 13.2 was the arithmetic mean for that. Then what you can do is, first of all, 15 minus 13.2, you have to square that, plus minus 6 minus 13.2, that is 19.2 squared, and 17 minus 13.2 squared, 18 minus 13.2 squared, 22 minus 13.2 squared, and that is to be added up and divided by 5, and the value has to be square rooted. Early fund also you do the same thing. Now for early fund, the arithmetic mean is 8.2. Then 10 minus 8.2, minus 2 minus 8.2, 13 minus 8.2, 9 minus 8.2, 11 minus 8.2, and to be square. Get the value, total value, and then divide it by 5 and then get the square root. Right now, has anyone got the square roots for those things? Sorry, standard deviations for those things? Now, when you calculate the standard deviation, that is the risk for that fund, risk of returns, early and Lotus funds. Lotus it is 9.86 and earlier 5.26. I will take these answers as correct, and anyway, now we can do the needful to calculate earlier funds and Lotus funds Sharpe index. So the return of earlier is Lotus is 13.2, and what is the treasury bill arithmetic mean? Arithmetic means of treasury bills. So then what we can do is you can get 13.2 minus the mean value of treasury bill rates divided by 9.86 will give you the Sharpe index for Lotus. And when you go to earlier, Yes. When you go to earlier, it is 8.2 minus 6.2 divided by 5.26. That gives the Sharpe index for earlier. Now get the find out the Sharpe index for Lotus and earlier. Yes, Ajipan, have you done the got the Sharpe's measure for Lotus? It should come as this way: 13.2 minus 6.2. That is, you can say 7 divided by 9.86. 7 divided by 9.86. It comes as 0.709. Just 0.71. Lotus. Good. And earlier it would be 5. Sorry. Earlier the arithmetic mean is 8.2. 8.2 minus 6.2 is 2. 2 divided by 5.26. .38. For earlier it is 0.38. Yeah. Good. Now, what is the more profitable fund? It would be Lotus. More profitable fund would be Lotus. By going through the Sharpe's measure. Now, what is our next task? We need to go for the Trenner's measure. In order to calculate the Trenner's measure, what we need to have? We need to have the beta of earlier and beta of Lotus. Now, can you just think about a way of getting the beta of Lotus and earlier? Now, what we need to do is we need to apply the capital asset pricing model to get the beta of Lotus and earlier. So after getting the betas of Lotus and earlier, what we can do is we can do the calculation, and risk premium is there and it is to be divided by beta, then you will get the Trenner's measure. Now, just remind, get the capital asset pricing model reminder. So it's, what is that? R will be equal to RF, that is the risk-free rate, plus RM minus RF into beta. RM is the market return. So how can you get the market return calculated? S&P 500 returns are given, and you have to get the arithmetic mean of S&P 500 returns. By that, you are in a position to get the market return calculated, and that then you have to have RM minus RF. So RF you have already calculated, that is 6.2. So in order to get the beta, you need to calculate these things also. Now do the beta calculation now. Now in order to calculate the beta, you have to calculate the market return also. So what is the market return here? They have given S&P 500 return for 5 years, and you have to get the arithmetic mean of S&P 500 returns. Now, when you get S&P 500 returns, now you have, you can calculate the arithmetic mean of that. 7, 12, 11, 30. Now that is 8.4. S&P 500 returns arithmetic mean is 8.4, and that is the market return. That is the market return, and you have other returns also. Yeah. Now, with the S&P 500 arithmetic mean taken as 8.4, that is the market return. Now, what you need to understand is, now you have to see how we can make use of that S&P 500 as the market return, because it gives a indication of the market. That is why we consider it as the market return. Right. Now you need to apply the capital asset pricing model. Now the capital asset pricing model I will put on the board. R is equal to RF plus RM minus RF into beta. This is the capital asset pricing model. Right? Now what you need to do is you need to apply the values available for these and get the value of beta. Now first of all you need to get the beta of ROE. Beta of, sorry, you start with Lotus. Beta of Lotus, so we can say RL, VL. RL is what? RL is, we just found RL. Lotus funds return is 13.2. RF is 6.2. RM is S&P 500's arithmetic mean. That what is the value we calculate? 8.4. 8.4 minus 6.2. Yeah. So with that, we are in a position to calculate. Now 13.2 minus 6.2 is 7. Divided by 8.4 minus 6.2 is 2.2. This is BL. 7 divided by 2.2. 3.18. So that is BL. So beta for lotus is 3.18. 3.18. And do the beta for earlier also, that is 0.909 as it is. Good. Right. Now, after getting the betas for lotus and earlier, now you are in a position to get the transformation with all other things available. So the risk premium for lotus is how much? Risk premium. Risk premium is 13.2 minus 6.2, that is 7. 7 divided by, for lotus, the beta is 7 divided by 3.18. That will give the Trenner measure for lotus. And for earlier, this premium is 8.2 minus 6.2, that is 2 divided by beta. Beta for earlier is 0.38. With that, you will get the Trenner measure for lotus and earlier. Yes, now you can go into the Trenner measures for earlier and lotus. Shall we get that also? Both the same value? No, 2.22 and which very close, no? In that case. In that case, they are too close. But now just see the early and lotus, sharpest measures are in a different footing, no? So that is the issue. I don't know whether anything wrong there. Anything wrong? No. Right. Now, if you find a difference, basic difference between Trenner and Sharpe measures, the meaning is now we went through a averaging exercise. Because of that, it happens that way. Because in the comparison, you have to make those things clear. Sharpe's and Trenner measures comparison. Compare the results of Sharpe's and Trenner's measures. Now, there's a big possibility of having this type of sum in your question paper. And see that the first sum also we have not tried, and you just try to see the answer for the first one. The Eastern Corporation has had the following returns over the past 5 years: 15%, minus 5%, minus 3%, 18%, and 17%. Determine the geometric mean rate of return for the Eastern Corporation stock over the past 5 years, and find out the arithmetic mean return for the corporation, compare it with geometric mean return. Right. This one also you need to do now. Yes, this is a very straightforward one, because you got the 5-year returns: 15, minus 5, minus 3, 18, and 17. So it will be the multiplication of all these 5 rates, and you need to get the 5th root of that, minus 1. Yes, the answer is 0.079. And as a percentage, it is 7.9. So what we need to do is we need to multiply. We need to multiply 1.15 into, now when you have minus 5%, then it will be 95. 1 minus 0.05, no? 0.95. 1.15 into 0.95 into then minus 3% means 0.97 into 0.97 into, when you have 18%, that is 1.18, and again multiplied with 1.17, and you get a value of 1.463056 something. Now we have to get the fifth root of this. Fifth root. How are we going to get the fifth root? Press yx, then 5, then 1 over x equal to. And you get 1.07907. And not only this, after getting the fifth root, you have to deduct 1 from that. So then you will end up with 0.0790. So then the answer would be 7.9. Or if you go into another decimal, then it will become 7.91. Okay, the answer would be 7.9. Now we have to do the comparison with the arithmetic mean. What is the comparison? 15 plus 18 plus 17 minus 3 minus 5. 42 divided by 5. 8.4. Now you can see the arithmetic mean at a higher level, that is 8.4, whereas your geometric mean is only 7.9. Right. Now, today we have discussed several performance measures, and what you need to do is you need to understand what type of a performance measure is applicable. Yes.
So when we have a comparison kind of a thing in a question paper, so what will be the expectation on answer as answer?
Yeah, expectation is now you need to say identify the particular situation where if it is a portfolio, then you can mention that it is a portfolio, and if it is an individual asset, then you mention that it is an individual asset. So in the lesson I just put I think the Sharpe measure is very much applicable for portfolios. But when you take Trenner measure is applicable for the both. And not only that, and if you are trying to deal with fixed income securities, Trenner measure is not that, even though we can use it, but for fixed income securities, we have to use the Sharpe measure, because the beta is not available for a fixed income security. Now you know what is a fixed income security. Now, if you are talking about a bond or whatever it is, you can have the value, the return is there, risk-free rate is also there, but when you have the risk or whatever, so that can be calculated, but beta cannot be calculated with regard to a fixed income security. So therefore, if such type of situation comes, then you have to just select the measure, Trenner measure for that. So such type of explanation is possible, and at the same time, for some of the things, both measures are valid. But only issue is if a beta is not available, we are not in a position to measure Trenner index. That is the issue. But when you want to do some comparisons, you have to really put forward all these ideas. So whether it is a portfolio, whether it is an asset or fixed income security or some market security or stocks or whatever. So such things you have to give and say that our performance measure based on these things. So that is how it has to be answered. Yes. Anything else? Now, I think all of you now understood. Now, sometimes in the sum itself, you might not get beta. You might not get sometimes the standard deviation, where you have to make use of the given information and find out those things. In most cases, in the determination of beta, you need to apply the capital asset pricing model in most cases. For that also, you need to have the market return. And there can be some information given with regard to the market return, and you need to find out the market return through the information. Yes, anything else? Right. Now we will go to another. Now you can just go through this again and get some idea from this. The Sharpe performance measure is based on the capital market line. Now just get reminded the capital market line, the characteristics of capital market line. Can you remember that? Say I just started with all those things, and I talked about efficient frontier, where you plotted some points in respect of assets return and its risk and return. So the risk is given in the horizontal axis, return is given on the along the vertical axis, and by looking at the risk and return values of certain assets or certain portfolios, the plotting is done. Plotting was done, and you got several points on the graph. But how are we going to demarcate the efficient frontier? So you look at the graph and see the points which are on the very edge, and you can connect all those dots. When you connect all those dots, you get the efficient frontier. It's a curve. Efficient frontier is a curve. Now, I am really giving you a revision of capital market line. Then what is the capital market line? You draw a line which is tangent to the efficient frontier, but that line starts from where? From the risk-free rate. That is the vertical axis. From the risk-free rate, you demarcate the risk-free rate there, and from that point you draw a line which will become a tangent to the efficient frontier. That line is known as capital market line. So Sharpe performance measure is based on the capital market line. Why do we say that? Because we are going to have the risk premium and the risk, total risk. Now you all now remember the standard deviation comes in the horizontal axis. What is the risk premium there? In actual form, the risk premium is the in the capital market line. If you take any type of a point on the capital market line and you see the height or the difference between the capital market line value and the risk-free rate is the risk premium. So the risk premium divided by the total risk will give you the Sharpe measure. Now you see the point there. The capital market line has a good or real connection with the Sharpe measure. But on the other hand, the trainer performance measure is based on the capital asset pricing model. That's why in order to calculate trainer measure, we have to go through this capital asset pricing model. And it is flexible also because by using systematic risk. But in the case of a trainer measure, it is applicable for both portfolios and individual assets. Now, this is what I need to tell you with regard to these comparisons and all. I think you can go through these things, and if you find any other literature available on this, and you can go through that also. So then you can have a good understanding about these two measures, basically. And of course, this future investment value also a type of a good performance measure, but it is a little complicated than the earlier measures what we talked about, because it really assumed a normal distribution. That is the issue. So in order to assume a normal distribution, you need to have behavior studied for a very long time. Then only the normal distribution assumption can be met. Now, when you look at this net asset value and 1 period rate of return, they are the application of tax. So that will give you a certain realistic analysis. So before tax and after tax returns, you can calculate and see how you really have a tax burden. In our case, this particular first one, which we calculated the tax applicable return is only 19.05, whereas the tax-free return is 27.26. That's a substantial tax burden is there. Now that is why I'm just referring to that here. Now, all these knowledge is very much necessary for you in order to do any type of analysis. Now, why the companies, if they declare overestimated profits, what will happen? Overestimated profits, they have to pay tax on them. Therefore, it is not rational for companies to give overestimated profits. I know some of the companies just do it in order to have a good picture in the eyes of shareholders, but that's not a good thing to be done. If they do that overestimated profit calculations, invariably they have to pay tax for the profit, but not for the real profit. So that then they will hit in two ways. They will get the hit in 2 ways. So these things also you need to understand. So I will just do another sum. So I will put it on the board. Right, I have put a sum on the board. Right. Now you can just look at it. Mr. Asoka invested rupees 1 million in a fund indexed with S&P 500. I will read it for you. Mr. Asoka invested rupees 1 million in a fund indexed with S&P 500. For the last 50 years, it recorded a continuous return of 12% and continuous standard deviation of 19%. If Mr. Asoka expects to have an investment value of rupees 3 million after 15 years, what is the probability of achieving this target? Then the second part, what is the probability of Mr. Asoka losing from the investment in next 10 years? So these are the two things what you need to calculate, and just start calculating that. Now what we need to do is you need to just apply the things, the values into the model. Right. Now, as a result, you get the values. So you can say future value is 3 million. Beginning value is 1 million. So therefore, you get the first one as log 3. Then you have RC into N. RC is 12%. So 0.12 into 50. So that way you can just try doing. Yes. What is Z? 0.95. Now in the denominator, you get the numerator that is log 3. Log 3 is 1.0986 minus 0.12 into 15. Then you get the numerator as minus 70138. Minus 70138. Now that has to be divided by square root of 15. Multiplied with 0.18. 0.19. Is the Z value correct? 0.9531. Yeah, if it is 0.9531, then you can go to the normal curve table and you can arrive at this. Yes. I will do the needful here. Z is equal to log FP divided by B minus RCN divided by sigma S square root of N. So this is the model. You can see it. Now, when you write these things, you get a familiarity of using it. Log FV divided by B minus RCN divided by sigma S square root of N. And just see, this is log 3 because 3 million divided by 1 million, which comes 3. Then what is RC? It is 12.12. N is 50. Divided by sigma S is 0.19. Square root of N is, now we can put the values there. Log 3 is 1.0986. (1.0986) minus 0.12 into 50. 0.12 into 50. That is 1.8. Divided by square root of 15 into 0.19. That is 0.7359. 0.7359. So the numerator is 1.0986 minus 1.8 minus 7014. So the answer will be minus 7014 divided by 0.7359. That is 0.9531 minus 0.9531. I think some of the people have got it correct, and those people got the answer. So the profitability, I mean, the first part I'm referring to. So 0.9531. So when you have 0.9531, if you go to the tables, you can see yes, 0.95. 31 means 0.95. 0.95 is somewhere here. You see this line. .1711. When it is 0.1711, then the profitability probability is 83. Yes, it is 83. I think that's correct. The answer for the first part, that is 83%. For the second question, now we are referring to the loss-making situation. Now, when you have the loss-making situation, what will happen there? I can change. This will become 1. This will become 1. This will become 10. Right. Now, accordingly, we can have the calculations. Now, log 1 is 0. Log 1 is 0. Then you have minus 0.12 into 10, that is 1.2. Minus 1.2 divide by 0.19 into square root of 10. So you can get square root of 10, 3.16, and it has to be multiplied with 90. Sorry, 0.19. 0.19 into square root of 10. 0.6008. Now the answer would be 1.2 divided by 0.6008. 1.997 minus 1.997. So you can go to the table. Yes, you can go to the table and you just check it. 1.99 minus 1.99 comes here. Here. 1.99. 0.0233. That is 2.33. Now the loss making probability will be 2.33. That means very low probability of making losses. Yes. And I think people have done it. Very good. Of course, now what I want to tell you is, though you can get the answer, but getting answer is good, but it alone will not help you to get the full marks. But in order to get the full marks, you have to write the things in a correct way, the assumptions to be given, and you have to show that you have identified the background and environment. So that will give you the full marks. So that is what I want to tell you. Right, now the today's discussion, we have focused on performance measures. Started with the net asset value per share. That's a very simple performance measure. Though even though it is simple, it has been in use, very frequently used type of performance measure, net asset value per share. And then we went into a 1 period rate of return. Then we come to GMR, that is geometric mean return. Either geometric mean return or arithmetic mean return. I think most of the time people go into arithmetic mean return, but I think what the more or less important, and I mean, in an investment scenario, the most valid rate of return would be GMR, that is geometric mean return, since the investments are not static. It is a dynamic type of a thing. So that is why GMR is more valid. Then we came to Sharpe's performance measure. The Sharpe's performance measure is altogether this premium divided by total risk or the standard deviation. That is the Sharpe's measure. Then we went into Renner's measure. In the Renner's measure also we look at the risk premium, and it is to be divided by beta value. And since the beta value is involved, it really talks on in terms of stocks basically. So that is the thing which we need to understand, because the beta is not realistic for a fixed income security. So therefore, the stocks and all will have a type of indications for trainer measure. Then we come to the future investment value models. The model which has been invented by the Chartered Financial Analyst Institution. And we went into that and we just had a practical area of practically how we can calculate the probabilities of future investment values, or even loss-making type of probabilities, and that type of things we have studied. And on certain assumption base, then when you get a sum like this, you need to assume as it is and give the correct assumptions. Without giving correct assumptions and just do a calculation and arrive at a certain answer would not give you the full marks. In order to get the full marks, you have to write down the assumptions and the situation on which you have found this performance measure applicable. These are the things which you need to show in the question paper. And the ultimate thing would be, most of the time those things would not come in one go, because there can be several principles involved in one particular problem. So in reality it happens that way. So there's no real life situation which you can really solve with only one principle. So all the principles are interconnected into certain real life issues. So therefore, the questions come in that nature. Okay. Now, any question? I mean, we can have some discussion afterwards. I mean, if you need to have any clarifications, what we have done today. Yes. Do you need to clarify anything? Any clarifications which are needed? Yes. If you need to clarify anything, now it's time for you to do that. We have another 5 to 8 minutes. Now, what you need to gauge is whether you are comfortable enough to deal with these issues. So that is the measure you have on your own. If you feel that it is not possible to have a comfortable type of thinking on these things, so you need to get more clarifications. Yes, anything? I can just read your names. Ajipan, Damayanti, Deepika, Dulsinder, Asini, Isiri Punyasiri, Geetika. Yeah. And all these people, actually, I think all of you engage in the session and have a live engagement. that I see as a Kanchana, Lakshani, Madhuma, Alpola, Malaka, Malinda, Mayuri, and all. I am not going to read each and every name, but anyway, so I really be happy because you all engage in the program in a lively manner. So anyway, I feel that you can gain something from this and get some value addition. And if you have any issues, let me know in the next session. And as I always telling you, because if you find something difficult and all that, what you can do is you can just write down those things, and next time you can ask me. Right. With that, I wind up the session today, and thank you very much for all of your live engagement. Thank you.